Welcome to the March Q&A. This month we have a lot of questions on how the market is looking, how the economy is looking, etc. So let's get started. So the first question is I heard an interview of a US fund manager saying that this decade will be net negative for equities. Can you share on thoughts on this? So yeah, I also heard that interview. I think it did the rounds of all the WhatsApp groups and things like that. Primarily because when somebody speaks extremely bearish uh, in a bear market or in a market which is stressed, that tends to catch a lot of eyeballs, right? So uh, because one, I think being or sounding bearish or being bearish sounds and seems more intellectual than somebody who is just optimistic or somebody who thinks that the world is in a good shape and getting better. uh, I don't know honestly what the next decade is going to hold. I don't think anyone has any clue either. I mean, if you really think about it, we don't even know what is going to happen next year, what is going to happen 6 months down the line. So, it's really, really difficult to talk about, you know, that XYZ will happen to this country or this economy or, this sector in the next 10 years. Uh, People who make those kinds of projections and forecasts, uh, it's best to ignore those forecasts because it's uh, just intellectual talk, nothing more than that. The best way to understand what the future holds, or our ability to predict the future, is to go back to the past. 10 years back, 2012, 2011, everybody was still talking about the global financial crisis. People were talking about how the system will deleverage itself, how the economy is going to pick up, what is going to happen because of the quantitative easing that was going on. People were talking about quantitative tightening. Those terms called taper tantrum started coming in slightly, I think 2013, 2014 kind of period. So, if you now fast forward to 10 years in 2022, when we are sitting here today, how many of or did anyone ever think that the bigger uh, determinants of the market would be the FANG stocks, or the rise of the FANG stocks, or uh, the complete domination of tech stocks over the last decade? Or did people think about uh, a pandemic? Did people think about a war in Europe? Right? None of these things were really in anybody's radar. So to say that this decade is going to be good, bad, ugly for XYZ country, company, industry, I think is those are just meaningless talk. What we really need to focus on is, in any kind of market, there are pockets of good performance. They may not be blowout performances, but they are good performances. There are some businesses which keep doing well, and our job as investors is to find those pockets. And a lot of times it will go against our inherent nature or of as investors. So sometimes, for example, I personally prefer compounding stocks, uh, but there may be a period when deep value or cyclicals uh, could actually end up becoming much more profitable than compounders. So the question is, as an investor, my job is to figure out that to the best of my ability, right? So that is what we should be looking at, instead of trying to look for projections of what is going to happen in the future. So, just to add to that, if I look at 2 decades, like so 2000 to 2010, you would have seen that India and most of emerging markets outperformed the S&P and the US markets handsomely. I mean, there's no comparison. In this chart here, the bottom line here is the S&P 500 and the top one is Nifty. So you can just see the kind of outperformance. Fast forward to the next decade, 2010 to 2020, the roles reversed. It was not that the Nifty or the emerging markets did poorly, they also did reasonably well, but the tech fueled US stocks did phenomenally well, right? My sense is that now again the tide is turning. I personally feel the Indian economy is in a much firmer ground than quite a number of years in the past. Things are getting much better. There's a lot of cleaning up of balance sheets at the corporate level. I think investments are coming back. Credit to commercial enterprises have started picking up. MSME loans again from the banking system to the MSMEs have started picking up. They're back to pre-COVID times. So signs are good, right? So I don't see a lot of reason for major pessimism for India. I think if India and Indian companies continue to perform well, slowly, I mean, right now what happens is everybody, people who are in the market, they take cues from the US market. So in first thing in the morning, they will check what happened last night to the Nasdaq, to the S&P 500, what's going on with the SGX Nifty. I think slowly, once there is this decoupling of performance, business performance, you will see that people will stop taking cues from the US market, right? And it might take a few months to a few quarters, but my sense is that is going to happen because performance is going to diverge, in my opinion. And then let's see how it plays out. I mean, that's the best we can do, right? Okay, so the next question is also somewhat related. It's related to the market. Markets are falling since the last 6 months, and I've just started investing during the pandemic. My portfolio is now in the red. It is also very painful to see the portfolio go down every day. What should I do? So before answering this question, let me try and take you to the let's see if I have this chart open. Okay, so this is the Nifty chart. This is Nifty monthly, and let me just go back. So okay, so this is starting from, let's pull it down a bit. So this is say around 2000, and what we'll do is, just taking a look at what has happened in the past, right? More as guidance, just to get a sense of what is par for the course when we get into equity investments. So this is the year 2000. We all know this was the time when we had a dot-com crash, and if you see, so roughly 21 bars, which means that 21 months the market continued downwards, or if you want to stretch it till here, 40 bars, so 40 months, so that's about 3 years when the markets kept drifting down, and roughly top to bottom, if you can see here, it's 58.85%. So more or less say that it was a 60% drawdown in that period. Now again, let's see what happened after that. 2004, right? Markets, this fast pullback, or in 2003, if you see 1, 2, 3, 4, 5, 6, 7, 8 months of continuous rise from less than 1000 on the Nifty to 1840, around 1900, and then you see again a drawdown here, top to bottom, 37%, so roughly, or 35%, and again a drawdown of 5 months. Then again the market kept going up, 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 up. Then we reach 2008. I think this was perhaps the one of the biggest falls. So again, top to bottom, you will see roughly a 65% drawdown, and it went on for about 14 months, right? Move ahead, again 2010, right? 2010, roughly 27%. 27%, or 28%, let's say, and again drifting for 13 months. So the point I'm trying to make, and again you see it here, there's been a significant fall. This was the COVID fall. So the point I'm trying to make is that it is the nature of the markets to go up and down, right? You will not get a linear up move. It is not a fixed income instrument. It's not a fixed deposit that you will get a fixed return, fixed positive return every year. This is, in equities, you have a factor of emotionality in the markets. Markets will go up and down, and that is why we keep saying that you need to have a longer term view, because you don't know when the bad thing will happen and the markets will fall 15, 20, 30, 40%. And as we saw, right, a 60% fall during global financial crisis happened. 25, 30% falls have been frequent, right? So if you get panicked with a 25% fall, you are going to find it very, very difficult to be a good long-term investor and be able to create wealth, right? So don't get flustered with falls. Now the challenge is that people get flustered because they don't have a plan in place. They're not very clear as to why they've come into the markets. It's something that they've not thought out. Now if you have come to the market because all of your friends are doing it, that you're sitting idle during the pandemic period, and opening a trading account is very easy and everybody was making money, then what will inevitably happen is, at some point in time, you lose money and you'll get out of the market, right? And once you get out of the market, it becomes very difficult to get back in, right? Because you will carry that mental baggage of having made losses. The better approach is to be more disciplined, to understand that this is a market which will give you both pain and euphoria, and if you stretch that over a period of many decades, 20 years, 30 years, 40 years, it will reward you perhaps the best across all asset classes. Because in equities, what you're doing is you're taking part ownership, you're partnering with businesses. If you're able to partner with good businesses that compound their returns over a period of years, as a passive, as a sidecar investor, there's nothing better than that, right? You are free to carry out your own profession, your own vocation, and spend a little bit of time doing your own research, doing your own investing, and take a little bit of capital from your savings and keep uh, investing in a disciplined manner and benefit from uh, the growth in businesses that the country and the economy and the world has to offer for you. Now, so that is, part of the markets. The other, short uh, points that I wanted to make related to this question, and a lot of, I know, the last 7-8 months have been very painful for a lot of people, especially those who are new to the markets, right? Because what you've seen is the markets, you got in maybe the first few months or first couple of years, everything that you bought went up, and you thought you were, making money in the market is very easy. It is not, right? It's like playing cricket. I mean, being Sachin Tendulkar can never be easy, right? He may make it look easy, but it is never easy, right? Markets will give you different conditions. Same like, if I take a cricketing analogy, you sometimes will get a spinning pitch, sometimes you'll get a very fast green top wicket, and as a batsman you need to be able to adapt. Right now you are playing in Perth or you are playing in Barbados, where the ball is coming up to your chin, and it's relentless hammering that is coming from both ends. One side probably you have Curtly Ambrose, the other side you have Courtney Walsh coming in bowling at you. Apologies for using all slightly older names, because these are names from my growing up years, people, cricketers who I used to follow and admire. So I am not saying that the current crop of cricketers are not as good, although probably they are not as good. But we'll leave that aside. So, as I keep always saying, right, investing is about psychology. It is if I use the Pareto principle, it is 80% psychology. uh, Everybody focuses most of their time and energy on stock picks, but picking a stock is only 20% of the game. What will you do with it? How long will you be able to hold on to it? What will you do if the stock goes up 30% after you bought it? What will you do if it falls 30% after you bought it? Will you buy more? Will you sell? So all those things impact you, and it how you react to it, how you behave, depends on your psychology, and that is why every individual investor is different, right? Because people will react and behave differently under different circumstances. Like I said, investing is a non-linear returns game, right? You might get a 40% return one year, minus 20% the next year, and you don't know when you're starting investing which year this year is going to be like. It could be a plus 20% year, it could be a minus 20% year. We don't know beforehand what is going to happen, right? But what tends to happen if you again stretch it over a 10-year period is that you will find that you'll have 4, 5, 6 years where markets are good, a couple of years when they are sort of going nowhere, up plus minus 8-10%, and there'll be another couple of years when markets will fall, net negative. We don't know the order, but roughly over the history of the markets you will find that this is roughly true. So that is what we have to keep in mind. So when you're getting into the market, and I keep telling this to everyone, when you're getting into the market, go with the mindset that the first 2 years I'll not make money, right? If you're in this game to play for 2 years, 3 years, my humble request to you is don't play this game. Don't get into equities if you have a time horizon of 2 years, 3 years. If you have a time horizon of 10 years, 20 years, 30 years, only then play this game. At least 10 years is what you should have, right, when you're investing. Otherwise it becomes a very, very difficult game. You can play if you have a 5-year horizon, but then you have to convince yourself that you have a probability of making net losses after the end of 5 years, right? Nobody can guarantee you in a span of 5 years that you will end up net positive, because we don't know. Markets can you know continue to be in a bearish phase for 4 5 years, although think it continues to look very unlikely because cycles have become much more shorter and sharper. But it's better to be conservative in these things in terms of expectations than to expect the moon and then get not get anything, right? So very important to think about what your investment plan is, what your horizon is. If you've come into the markets for a 10-year period, don't look at your portfolio every day. If you have bought a good basket of stocks, you don't have to every day look at quotational prices, right? If you have a trading strategy, right, then you need to manage your risks. You need to have stop losses in place so that you don't have large capital losses, because there you are not relying entirely on the fundamentals of the business. You're relying on price as one of the prime determinants. So it will depend, how you approach the markets will depend on what kind of investor, what kind of trader you are. If I were young, or if I were younger and I was in my 20s and I've got a job, I'm earning, or I'm in business, I'm making regular cash flow, a reasonable bear market is actually a God gift, because that is coming in at a phase when I'm accumulating my wealth. If I keep doing my SIPs, I will keep getting, I'll be able to accumulate more of the businesses that I want to buy into. And I know that bear markets don't last more than a year, 2 year, 3 year period. And once I get out of it, I will be much better off. So the belief and the faith in businesses, in equities, and people who are able to generate growth, that is what you should be convinced about if you are investing in equities. And lastly, I think very, very importantly, you don't want to be a forced buyer or a seller in the market, right? And if you invert that problem, that what will I need to do if to not be forced into buying or selling, is you need to have proper portfolio allocation. You need to not have leverage, right? You should not be taking a loan and investing in equities so that you get margin calls, or somebody asks you for return of the capital at a time when things are not going your way. And also that you should not be dependent on income from the market for your regular life and lifestyle expenses, right? If you have a job, your job should take care of your monthly expenses, and investment should be a vehicle for wealth creation, right? If you have this part sorted out, then the best idea is to maintain a focused discipline on your investment plan. Focus on your time horizon. Keep repeating it yourself. Keep repeating it to yourself. Why you've come to the market, what is your objective, what is your plan, and then you will, a lot of these things, this mental clutter, you will find it will go away, right? This whole approach, or continuously looking at what my portfolio has done, panicking or getting euphoric, none of this will happen. Okay, now moving on to the next question. You spoke about behavioral psychology in finance in the session. Can you please elaborate from long-term investment perspective and your biggest learning in this area? Salil Parekh, CEO of Infosys, told in Business Standard that every company wants to be a data IT digital company. What is your views from this on this perspective? And finally, any new company to keep watch from this view? Very interesting question. First of all, I think, like I said before, behavioral psychology, your mindset, is absolutely the most critical element of your investment. You can buy or two people can buy the same stock at the same time at the same price and yet have completely different results, because one of them is able to withstand different psychological upheavals of markets going up and down, and the other person may not be able to do so. It's not only about buying and holding. It could be that one person is able to cut losses when the time comes, if the investment is not doing well or if the thesis is not playing out, whereas the other person may not be able to cut losses. And something which is very very common, I keep seeing price anchoring, people waiting for the price to get back to their level which they bought it at. LIC IPO, I see so many of my friends stuck there. It might take years for the LIC IPO to get back to their to its IPO price. I don't know, right? It might happen tomorrow. It might take a year or 2 years. In that time, you're blocking your capital. Why? Because you want to get back to even. Why should, or I mean, does the LIC stock know that you own it? It doesn't. Is it obliged to you to give back your price? It isn't. So these are mental games we play with ourselves, right? So psychology is by far the most important. Like I said before, how you react to bull and bear markets, how you react to news, these are things which will determine how you perform as an investor. I see a lot of denial, even during bull markets, in bear markets, both cases. I mean, this is the same on both sides. People are in denial when markets are going up. They think that they are they don't want to accept the fact that things can get worse, right? Similarly, in bear markets, now if you look at the market commentary everywhere around you, you will only hear negative news. You will hear about inflation, you will hear about US markets are going to go down, and you are hearing that India is there's so many problems, there's trains being burned for Agnipath, or there's some rallies going on somewhere, and so all sorts of social unrest. And if you read the newspaper, if you listen to the news, you'll only get negative news, right? And in that kind of a mindset, you will find technical analysts on different forums, whether it's TV, whether it's WhatsApp, Telegram, YouTube, and even forums like Value Picker, right, where you'll find some people coming and only talking bearish and saying that putting up charts and saying that the world is going to end tomorrow. Now the thing is, it's very easy to get caught up in the trend of today. Most analysts, most people just project the current situation. If things are good, people project that things will keep being good and may get better. If things are bad, people project that things will get worse, or it will continue to be bad for for a long time. Not necessary, right? At some point in time, the most important thing is to remember is this too shall pass, right? Whether it's good times, bad times, times change, situations change, fortunes change. Anil Ambani 20 years back and Anil Ambani today, not the same. Vijay Mallya 20 years back, Vijay Mallya today, not the same, right? Similarly, on the other side, Gautam Adani 20 years back, Gautam Adani today, not the same. Mukesh Ambani 20 years back, Mukesh Ambani today, not the same. And so and so forth. And lot of people, lot of entrepreneurship happening in India, a lot of great companies are coming up, different businesses are doing well. So I don't find any reason to be continuously bearish or continuously bullish. You have to understand what is going on, use your analytical mind and see, try to differentiate between what is happening and what you think might be happening, or what you hope might be happening, and try to use a lot more of data instead of listening to people's opinion. So sorry for the rant, or sorry for the rambling, but ultimately, uh, my biggest learning has been that when you're investing, you need to have the time frame in mind. Your strategy, everything depends on the time frame. If you're investing for 30 years, you will have a different mindset. If you're investing for 3 months, you will have a different time frame. So if you're investing for 3 months, you will have a different way of playing the game. So most important for me is to understand what game you are playing, right? That is the most important thing, and then accordingly uh, uh, strategize differently. So Sachin Tendulkar playing a test match will play differently from Sachin Tendulkar playing a T20 match, right? So the format is different, you will have to adapt differently. Exactly the same way here, if you're playing a long term game versus a short term game, you have to adapt differently. Coming to the data part of the question, I think data is increasingly becoming very, very important. But the challenge is that raw data has no value, right? It is ultimately uh, about the analysis. What you do with the data, right? Uh, Gathering and analysis of very large data sets is becoming possible because of a lot of IT and IT systems, which was not there, say 20, 30, 40 years before. It was not possible. Today it is possible. You can access and analyze data in a much better manner, much faster, and that is giving edge to a lot of businesses, right? So every business in some way or the other is using information, is using data to improve their business, and that is why you will find that productivity of businesses keep inching up, because they are able to use the data to run their businesses more effectively. So yes, every business uses data in some format. With more and more uh, influx of software and IT systems, the use is becoming much more rampant. Much more and more immersive. Lot more usage is happening. So that is the good part. Uh, which companies to look for? I don't think there are specific companies which do a lot of data analysis in India. Uh, a lot of you might have heard my opinions about IT companies. I struggle to find good IT companies in India because I think everybody is the copycat of the other. Uh, there's hardly any differentiation. Very few. I mean, maybe a total of 5 companies will have some differentiated product or offering or service offering. Everybody else is, if you just change the name tag of the company, it's pretty much the same, right? Everybody uses the same jargon, and I'm saying this because I've spent so much of time in an IT company in India, and I have friends across the industry who are at fairly senior levels at this point in time, and I see what is going on. I've seen this for many years, and I find IT companies not very interesting, not very uh, you know not operating in some niche, if I may put it that way. But does it mean that we cannot invest in IT companies? It does not mean that. Again, it depends on what game you are playing. The other thing is, beneficiaries of data management need not only be IT companies, it could be other companies, even a retail company, how it manages data, even logistics companies, the supply chains, manufacturing companies, auto companies, lot of these companies today are using data and IT systems. So we can see benefits of IT and data from a lot of these companies. The last question for today, can you share your thoughts on the major shifts in the world that is happening or is underway? So I'd actually written a detailed article or a post some time back, and I've given the link here. So in the long term, I think there are 4 mega trends that are sort of playing out. And whenever we are looking at long-term investing, we are trying to fit in the businesses into one or more of the categories of these four pillars. The first one that I'm looking at is a China plus one. So what is happening is silently a lot of large MNCs are either moving away from China or are looking for multiple sources. So they don't want a single source of failure. So that's one. Second is climate change. So anything and everything related to climate change, whether it's sustainable energy, renewable energy, EVs. So all of this comes into this climate change bracket. A lot more of focus on net zero and reducing carbon emissions. So that's going to be a theme for the next few years or next few decades. Digital and technology, like we discussed in the previous question, every industry is getting impacted by technology, whether it's in their distribution, whether it's in their supply chain, whether it's in their internal operations, whether it's how they reach out to their clients. So a lot of technology is getting into all businesses. Even businesses like farming, right, is getting a lot of technology influence. You're not there is no app to help you sow seeds, but there are apps today that help farmers to determine exactly what is the soil quality, how much nutrients, how much fertilizer to put, how much watering should be done, when you should sow seeds. So all of those enabling technologies are there today. So that's going to be that will continue to be a very big theme. Health and wellness, I think a lot more people with better prosperity, I think there is going to be a lot more focus on being healthy, increasing your health span, your lifespan. So preventive care, so a lot of focus on that is going to come in. So these are broadly the four main mega trends that I personally watch out for. And in addition, I think a couple of more that have come in, which are part of these four, but maybe it's important to call them out slightly. One is, I think, the era of cheap money that has been going on is over, at least for the time being. I'm not sure it's over for good, because cheap money is like a drug. It's like cocaine for central bankers. Once you are on it, it's going to be very difficult to get yourself away from it, because if you found that throwing money at a problem either solves the problem or kicks the can far enough so that you as a bureaucrat, you are able to be in office and get out in a good light, then that is what most people would do, right? Again, incentive cost bias creeps in here. So everywhere you go, ultimately it is behavioral psychology, right? So I think that era may not be over. Once the pain of inflation, etc., cools down, it's not unlikely that you will see a lot more of targeted handing down of money to people, not only in US, in developed markets, but in across the world, because I think people have understood, or politicians have understood, or central bankers have understood that handing out money to people is a good short-term move to solve a lot of pain points, right? And in the process look good yourself. But for the time being, I think the era of cheap money is over. So a lot of these PE-funded exuberance in private markets is going to die, or is already dead. If you look at IPOs, overpriced, loss making, with absolutely no clue of how they will ever turn a profit, very poor unit economics, those kinds of companies will not survive probably over the next 5 years. So that's one trend again that is going to pick up. The other thing is, again, with this COVID, with Russia-Ukraine war, what the world is now sort of realizing is that globalization, single sourcing is a challenge. So, like we are seeing China plus one, we are also going to see a lot more of diversified uh, outsourcing, right? Globalization is not going to stop completely, simply because every individual country, especially the developed countries, neither have the manpower, nor do they have, you know, skilled, uh, you know, skilled labor, if I may could call it that, or people who are willing to work at a level where the product becomes affordable for consumers. So outsourcing, all of this will continue, but like what we are seeing in China plus one, we will see multiple shoring. Uh, we are also going to see a lot more of outsourcing to politically friendly countries, right? So friend sourcing is what people are calling it. So friend sourcing is something that we are going to see a lot more of, and increasingly you will find a lot of geopolitical frictions coming up. China on one side, US on the other, uh, you know, people sort of getting into different blocks, and it, again, this is going to be a long term theme. And lastly, I think uh, increased self reliance within countries, within companies, within businesses, keeping higher inventory, moving away from, just in time to just in case kind of a model, where you want some kind of inventory just in case something goes wrong, right? So these are probably, so all of this, I mean, cheap money, deglobalization, and self-reliance and increased inventory is are all long-term inflationary trends, right? You are moving away from the cheapest source producer to maybe the second and third cheap producers, but obviously that is going to be inflationary. So inflation is going to remain, whether we like it or not, for the next few years, in my opinion. There's going to be a lot of pressure from the central banks, by raising rates, by doing all of these things. Ultimately, in my opinion, doesn't make sense, simply because if you look at India as a country, uh, most of our inflation is coming from things we import, whether it's oil, whether it's crude, whether it's palm oil, those kinds of things. If you are within the country and there is inflation, say for example, potato or tomato or onion prices rise, it's basically a shift of money from one person's pocket to the other. So I may be paying a little bit more for my onion, and the farmer or the person who's distributing it or the retailer is getting a bit more. So ultimately the money is remaining within India, within the system. The problem starts when we have to import stuff, and we are exporting our savings, and giving away the money to somebody else, right? So that is where the challenge starts for. And then the problem with a crude importing country like India is that we have it is a necessity and we have to import it, right? So no amount of rate hiking is going to reduce oil prices. So with that, basically, I think these are the factors that are going to impact in a broad sense. We'll keep monitoring what's going on. So with that, I think that was the end for today. Thank you for sending me your questions. Do keep sending them in, and I'll come back again next month. Thank you.